Hello and welcome to this latest Robeco market update. After a strong whole of market rally in the last part of 2023, it was a much more mixed bag for different asset classes in the first part of this year. Better than expected US economic data further pushed out expectations for interest rate cuts, and this created a bit of a mixed divergence of fortunes between equities and government bonds in particular. So this quarter, asset allocation decisions made a real difference to performance. Going into a bit more detail, markets started the year expecting 7 interest rate cuts. By the end of March, that had dropped quite dramatically to only 3 cuts. This really hurt the more rate-sensitive parts of fixed income, such as government bonds. Relatively strong earnings helped to support stock markets, and indeed US equity benchmarks touched new all-time highs. But perhaps more importantly, the market breadth has really improved, and the rally is no longer driven by the Magnificent Seven tech-focused US companies. This shift away from the narrow market that we saw for the best part of last year should start to create more opportunities for active management, particularly on the equity side. Despite better than expected economic data, European equities did trail other developed markets. That said, we are starting to see some encouraging signs with falling inventories in those European industrial companies. But we have yet to see a confirmation of the shifting into a restocking cycle. Emerging markets, it has to be said, were a bit slow out of the blocks at the beginning of 2024, but they did recover some ground in February and March. Elsewhere, oil prices rallied in the wake of further disruption in the Middle East, touching $90 a barrel. There are also concerns on the supply side following Ukraine's continued aerial assaults on Russia's oil infrastructure. In the first quarter of the year, the portfolio delivered a positive return. With the exception of the Robeco government bond funds, all allocations contributed positively to the overall performance. That said, it remains a challenging environment for the equity impact funds. Only 2 of the 6 impact funds outperformed their benchmark this quarter. But looking forward, valuations are now at historic lows, and we are starting to see green shoots that sentiment is starting to turn a little bit more positive. Towards the end of the quarter, we did decrease the allocation to corporate credits, and we reallocated that to government bonds, cash and equities on an equal basis. The rationale behind this is that we see that the upside is more limited for corporate credits right now. In terms of fund selection, Global Enhanced Index and Robeco Sustainable Global Stars were really the star performers over this quarter. Within the Enhanced Index Fund, an overweight in the best performing sectors really played out quite well over the first 3 months of the year. Moving on to Sustainable Global Stars, here performance was mainly driven by security selection. For instance, Meta Platforms performed very well after strong results. It was another good quarter for Eli Lilly on rising optimism around its GLP-1 products targeting obese patients. The continued strong performance of the Sustainable Global Stars segment highlights the investment team's ability to outperform in a wide variety of market environments, and that's part of why we really like the strategy in the portfolio. This quarter, the macro picture continued to improve. While the direction remains towards improvement, compared to last year, we have to accept the pace is a little slower. The early signs of a recovering manufacturing sector in combination with a still healthy job market point to a steady growth environment going forward. However, the jury remains out if this will move to a restocking cycle, particularly within European industrials. The favourable macro backdrop is also beneficial for high yield and investment grade credit. That said, we prefer equity to spread risk, as we see the upside opportunity as more capped in corporate credit compared to equities. The rally we've seen over the past months has been, perhaps we could say, fast and furious, and the question must be raised if most of the good news has now been priced in. Still, with the exception of parts of the US market, equities in general are not extremely overvalued. A positive is that the rally is broadening. Japan, China, Europe all have either outpaced or kept up with US equities over the past couple of months. We still think there is some room for equities to strengthen, and we do prefer to take our risk within equities in Japan. And that's because Japan has the highest earnings revisions and there is a corporate structuring story at play. We also remain overweight in emerging markets as we feel there is more value to be unlocked. Admittedly, this does hinge on policy measures by the Chinese government that up till now continue to be quite piecemeal. For safe haven assets like bonds, it's been a more difficult situation, as sticky inflation in combination with relatively dovish central banks are not ideal. We don't see this changing on a more short-term basis within government bonds. We prefer to stay more or less neutral in this part of the portfolio today. Thank you for taking the time to listen to Robeco's latest investment views, and we look forward to giving you our latest insights at the next quarter.